What's up, everyone? It is Dividend Grinder, and we're just taking a look at the portfolio right now. We're just under 27,000. I was above 27,000 for a little bit when GLPI was hitting new 52-week highs. It's dipped a little bit, and the portfolio has been a little bit flat, a little bit down ever since Google took a little bit of a hit, and also 3M has taken a little bit of a hit. But that's not the topic of today. Today, we are going to be talking about holding cash in your account and whether you should or should not do it. So what you're going to find out as this video goes on is that there pretty much is no right or wrong answer. It ultimately boils down to what type of investor you are and what type of risk tolerance you have. So the common justification for having cash in one's account is that you kind of wait for the market to dip a little bit. That way you have reserves in your account and that you can just easily buy value stocks when they're nice and cheap. That's the whole point of having cash in your account. It also makes you a little risk averse. So you're avoiding the risk by having all of your eggs in the stock market, holding off with some solid cash that can't go down. And that's ultimately the appeal to holding cash. You're ready to pounce with a nice reserve for when the market takes a dip. So the other side of it is when you do not deploy all of your cash, there's the whole argument of lump sum versus dollar cost averaging, which would say that lump sum investing is ultimately the way to go. So if you're holding on to cash, you're ultimately missing out on opportunities if the market keeps going up. And the Vanguard study that I have a video on, lump sum investing versus dollar cost averaging, proves that lump sum investing wins out in the long run. So theoretically, you should never hold cash. You should always deploy it when you have it. That being said, if you don't have the money on hand, you could also do dollar cost averaging, although the research shows it's a little bit inferior. Nonetheless, that's what I ultimately do. So if you're looking at my portfolio right now, you see I only have 4 cents in cash. I deploy it all the time, and I think I'm going to change that. That's kind of why this video topic came up. I think I'm going to start conserving just a little bit more cash. So for those who don't know, I invest $30 every single day into the account. And anything that I get from Amazon Mechanical Turk, if I get YouTube earnings, if I get dividends, I will also add all of that, any referral income, also add that on top and immediately invest it that day as soon as I have the money. So I think what I might start doing now is I will invest all $30 that I initially deposit, and any dividends, any Mechanical Turk income, YouTube income, maybe I'll hold on to a little bit, at least a large majority of it, let it pile up, and ultimately sink it into some value stocks when the time comes. There's also the argument, and this is where it gets a little complexing. There's studies showing that value investing truly does beat growth stocks. So what this is telling you is that when you do buy stocks when they're at bargain bottom prices, that you do outperform the market and you outperform growth stocks, which you think would do better in a rising market. But value investing has been shown to be the superior investing style. So you have kind of this contrast between lump sum investing is technically superior, yet value investing is superior. So the ultimate combination, at least in practice, would be that you have a lump sum and you put it into a value stock. So inherently, there is nothing wrong with holding cash in your account and not holding any cash in your account. That comes down to one's risk. So if you believe that you can afford to take on a lot of risk, then you might be keen to have a lot less cash in your account and deploy as much cash into stocks and your assets as much as possible. If you're a little more tentative with investing all of your money into the stock market, you're typically a person who's going to have more in your cash balance. Now, that being said, do you really want to have it all in your cash balance? Because when you have your money in the cash balance, not only are you losing that opportunity cost, but you're losing value due to inflation. So you're not even beating the rate of inflation. So what a lot of people do, and this is what I did have in my portfolio for a while before I changed it, is instead of just holding on to cash, you'll put it in a very short-term bond, ETF, short-term liquidity asset, something that's very quick, will give you a little 2 to 3% yield. Nothing spectacular, however, can help beat the rate of inflation, if not at least slow the effects of inflation on your financial assets down a little bit, rather than just holding your cash straight into cash and not having it into any holdings, because then you're just losing inflation and you're not gaining anything in the short term. Now, you could make the argument that if you put investments in a 2% yield, inflation's 2%, it cancels out, and then you have to pay taxes on those gains, so it really doesn't work out in the end. You can make that argument. It really boils down to your philosophy, how much risk you want to take. Do you consider putting your spare cash in the short-term bond ETFs, or do you consider holding cash even though you might lose out to the rate of inflation? Do you consider the safety of having pure cash on hand? Do you consider that worth losing out to the rate of inflation? That ultimately depends on one person's risk tolerance. So I'm going to start just holding on to a little bit more cash. But again, this is it pretty much depends on what type of investor you are. If you are a pure 100% value investor, then yes, it probably would be wise to hold a lot of cash on hand. So to put it into perspective, Warren Buffett has over $100 billion in cash. That was me looking at, I think it was either 2017 or 2018 data, but he had over 35% of his entire portfolio in cash. So Warren Buffett is a value investor. He typically likes to buy stocks when they're down, stocks when they're either new, or good acquisition opportunities when they're cheap. So he right now has been hoarding up a little stack of cash, and he's waiting for the opportunities. He said in a bunch of shareholder letters that he thinks that the market is about fair for where the valuation is, but he just doesn't see too many cheap investment value opportunities. So right now he's holding cash. And that's ideally, if you're a value investor, what you're looking for. You're looking for value. And if there is no value, don't waste your money. Don't fool around with it. Don't take the risk of putting it into an already high market. You wait for the price to drop. Now, if you look at the other side of the coin, you could argue that, well, you can't really time the market. So even if the stocks are going down, and then you take, let's say you have $2,000 in reserve, and let's say Google dropped 30%, and you say, okay, right now I'm putting all 2,000 into Google. You don't know if it's going to drop another 20%. You don't know if it's going to drop another 30%. I know back in the 2008 crash, Google crashed over 50%. So if it was down 25% at one point, you're thinking, wow, this is it. This is when you value. When you lump sum it, well, you're still not getting the best of the value investment. So you can't time the market, but the research shows that value investing does beat the market. So you have to be really smart. You have to look at the fundamentals of a company during a recession and determine whether the price drop is true value, or if it's the market is finally just taking what should have been a crap stock and it's finally discarding it, and the recession would kind of just fuel that discarding of the stock. So you have to do your research. You have to know the fundamentals of the company. If the prices of these shares just plummet, but the fundamentals remain the same, and that's why you invested in the company in the first place, then it's a good idea to dump your money. Even if you don't time it perfectly, which, let's be honest, no investors time any long-term investments perfectly. But if you're playing the long game, and if you're buying when the price gets lower to what you believe is a discount, then holding cash is a great opportunity. So ultimately, it boils down to what you prefer to do. Me, I'm going to start building up a little bit more cash. I believe, this is just me personally, I believe the market should start correcting here. So earnings results for companies have been mixed. Apple was okay, but they're not really doing anything. They're just kind of hoarding a lot of cash. I mean, they have a lot of cash, and they probably could have raised the dividend a little bit more, and they didn't. I mean, Google had pretty tough earnings for their standards, still 9.5 earnings per share. Earnings are coming in a little bit mixed. 3M had a really bad quarter. Yum Brands is going down. I'm just listing stocks that came off of my portfolio. So earnings are mixed. Some did really well, like Facebook, and others not so well, like Google and 3M. So earnings have been mixed. The economy is really roaring right now. How high can it go? No one really knows. So while I won't invest, or while I won't have about, like 40 or 50 or anything insane in my account holding in cash, I would like to get about 5, maybe 10% tops of my account in cash. So I'm going to be building my cash stacks up a little bit more. And when I get good value investments, I will deploy some of that money, and I will show you guys along the way which investments that I do eventually go into when I start doing more value investing picks. Right now I still have a combination of just flat out blue chip stocks thanks to the PPC EMPI, and Aero and tech stocks such as Raytheon and Northrop Grumman and Lockheed Martin. And also I have some high yielding dividend stocks, something like an O Realty Corp, something like a Stag, something like an LTC Properties, ERP Properties. So I don't really have too much in terms of value investing right now. It's something that I would like to get into. There's really not that much value in the market right now. That's just plain and simple. That's just how the market is right now. There's nothing you can do about it. You kind of just have to sit and wait and play the waiting game, especially if you're sitting on a large stack of cash. You really have to be patient. It really tests your patience. And you have to weigh out, is the opportunity cost of losing out on a rising market and losing out on potential higher compounding dividends, is it worth it for you personally to wait it out and get those very cheap prices that you think or assume is going to come in the future? Hope you enjoyed this video. Hope you enjoyed this perspective, my perspective anyway, on cash. I believe it definitely varies between person to person. There's really no right or wrong answer. It really depends on one's personal preferences. Hope you enjoyed this video. If you're interested in investing in M1 Finance, I leave a referral link in the description below. You use the link, you invest $100, you will get 10 for free. This has been Dividend Grinder. See you guys and gals in the next video.